We have a shocking new report out from CFOs in CNBC's quarterly survey that shows 75% of them expect a recession over the next 12 months. That is up from only 7% of CFOs last quarter. Something has decisively flipped, and I'll give you the details in this video. We also have Moody's that essentially says the US credit rating is at risk. Goldman Sachs is suggesting that following Trump's flexible comments and kind of downplaying what April 2nd tariffs could look like, we could actually be negatively surprised by the tariff announcement next week on April 2nd, and this could send stocks lower. UBS also believes that the S&P could hit 5,300, a decline of about another 8% or so, just on a weakening consumer. And, well, their earnings expectations, they expect to continue to move lower. And this could drive even further downside pressure in markets. We will go over all of this and much more, including the hard economic data coming out this week that's going to drive the next leg either higher or lower for markets. So first things first, CNBC does a survey, a quarterly survey of CFOs, of corporate CFOs, chief financial officers. The bottom line is recession is coming before the end of 2025. They are generally pessimistic, says corporate CFOs. It goes on to say that 95% of CFOs said policy is impacting their ability to make business decisions, and many said while Trump is delivering on promises, his administration's approach is too chaotic, disruptive, and extreme for businesses to navigate effectively. Wow, that doesn't sound good. In a word, the, quote, pessimism has creeped back in where the animal spirits had been after Trump's election. That's one way to sum up the results from the latest CNBC CFO Council quarterly survey for Q1 2025. While some chief financial officers said Trump is doing what he promised on the campaign trail, many CFOs said the way he is going about delivering on his agenda is not what was expected. Quote, too chaotic for businesses to navigate effectively was how one CFO respondent framed their view of Trump's second term to date. Extreme, disruptive, aggressive, a wild ride were some of the other ways CFOs portrayed their current view. In all, adds up to a majority of CFOs, 60% saying they expect a recession in the second half of the year. Another 15% say a recession will hit in 2026. So effectively, 75% of large company CFOs expect a recession over the next 12 months. Just a quarter ago, when the recession question in the quarterly survey was laid out, the Fed, rather than Trump, in the Q4 2024 survey, we asked whether the central bank's efforts to tame inflation would lead to an economic slump. Only 7% of CFOs said they thought that was on the calendar for 2025. Wow. In recent weeks, recession has become a more popular default setting in the market for the first time since the Fed began aggressively raising interest rates to beat back runaway inflation in March 2022. The odds of recession are running as high as 50% at some financial firms. New, quote, recession watch indicators are being created, and other recent CNBC surveying among money managers and economists shows a spike in recession fear. U.S. trade policy is the primary reason for the new economic downturn base case. It is now being cited as the top external business risk by CFOs at 30%, followed by the related risks, inflation at 25% and consumer demand at 20%. 90% of CFOs say tariffs will cause resurgent inflation, and as CFOs worry about prices, expectations for the Fed for when the Fed can engineer it back down to 2% in keeping with its dual mandate, keep getting pushed further out. And pressure on U.S. Treasury bond yields is expected to remain, with 65% of CFOs saying the range will still be between 4 and 5% at the end of 2025. 50% of CFOs expect yields to stay within the lower end of this range, between 4 and 4.5% where 10-year Treasury yields are today. So you're talking about a potential recession, but not a lot of CFOs think bond yields are actually going to come down, probably due to inflation pressures and the Fed not being able to react as they normally would if you were going into recession. Now, I think that's BS. I think the Fed is going to cut rates a lot if we start to go into a recession. That's, I don't see an environment where we get a recession and the labor market starts to really deteriorate and we have an inflation issue. That's just not how things work. We're not going to have an inflation issue if we have a recession. It's one or the other. If you have a recession, no inflation issue. If you have an inflation issue, then no recession. Because why? Because companies respond to demand. So imagine you run a factory. I don't care what it is you build, okay? Everything will sell at the right price. If Lamborghinis were selling for $80,000, you would see a lot more people driving Lamborghinis around, but they sell for hundreds of thousands of dollars, so they're a little bit less common. But same goes for everything else, whether it's a computer mouse or a book, or doesn't matter what it is. Price is important. So when you think about a factory that, let's say, can produce, 100,000 of these Axe body sprays a day, okay, at $5 a piece. I don't think it might be $5. I don't even know how much they are, honestly. But let's say $5 a piece. Well, now we're going into a recession. And the factory can produce 100,000, but people are only buying 80,000 at $5. Well, the company may decide to lower the price to $4. In that scenario, now they maybe can sell 95,000 a day. Then they drop the price a little bit further to $3.75, and boom, that's the magical number. Now they're selling 100,000 a day again. That's why you don't see inflation during recessions, because companies would rather lower prices than idle their factories, because that usually costs a lot less. Okay, and factories, companies tend to lay people off, things like that as well. So this whole middle ground where we have a recession and inflation, it's just not true. Now, I did find that very fascinating, but today we also did get the CB Consumer Confidence Index for March. Last month, you were at 100.1. Check this out. You were expecting this to fall to 94. In fact, it fell to 92.9. This thing is plummeting. And this is, again, some of that soft data that does eventually tend to show up in the hard data. Now, we have hard data coming out tomorrow with durable goods orders. I think you're probably going to get a really negative number there. That could be scary to some folks on Wall Street. GDP growth rate, quarter over quarter, final numbers for Q4. That shouldn't move too much, but again, it's always possible that it does. That comes out on Thursday. But the big data is personal spending for February. If that comes in negative again, oh boy, do we have a problem. Personal income month over month, and core PCE will also be coming out on Friday. Now, also hitting the news headlines today, here in red as a big breaking news story, Moody's, the rating agency, says U.S. fiscal strength deteriorated further since the rating agency assigned a negative outlook on the U.S. sovereign rating. So that's kind of like saying, guys, you're getting even worse. If you keep getting worse in your fiscal strength, fiscal outlook, we may have to downgrade you from AAA. Moody's says, even in a very positive economic scenario, U.S. debt affordability remains materially weaker than for other AAA rated sovereigns. So saying the U.S., you don't really stack up that well against other AAA rated sovereign nations. Now, UBS says the S&P 500 could hit 5,300 due to visibility tiring U.S. consumers. UBS strategist Benju Bawija, warns the S&P 500 could fall another 8% to 5,300, citing a tiring U.S. consumer. Key risks include weakening employment expectations, spending outlooks, and consumer confidence. He expects profit estimates to drop in the next few months, adding pressure on markets. Concerns also stem from upcoming U.S. tariffs set for April 2nd and Trump's unpredictable trade policy. Boeja notes the slowing U.S. economy, reduced immigration, and lack of new fiscal stimulus are now showing in the data. Analysts have cut 2025 S&P 500 earnings growth forecast from 12.5% to 9.5%, with more reductions likely. Think about how crazy this is. Since 2000 until today, the average year for EPS growth is 5.25%. The average analyst still is expecting almost double that at 9.5% EPS growth this year. Let alone if we go into a recession, the average EPS decline is 15%. Like, imagine that. Imagine what happens to markets if we're expecting 9.5% EPS growth this year, but instead we get 15% negative growth this year in EPS. Yeah. Again, that's why I'm not overly optimistic about the markets as a whole here. And again, Moody's says United States fiscal strength on course for continued multi-year decline. Fed Williams says households and firms are seeing heightened uncertainty. And Fed Kugler says latest economic data for early this year have shown some signs of softness. Kugler says return of positive goods inflation is unhelpful as it had helped keep a lid on total inflation and inflation expectations. Fed Kugler says it is estimated that 12-month PCE was 2.5% in February based on CPI and PPI data, and we get that PCE report this upcoming Friday. Now, Goldman Sachs says that April 2nd could bring a negative tariff surprise. Goldman Sachs economists note recent media reports have suggested the Trump administration is leaning in a more benign direction on tariffs. Don't be fooled, they write. The attitude probably sets markets up for a negative surprise. Goldman notes that the Trump admin has seen tariffs as a negotiating tool and will likely want to start from a position of strength. A recent Goldman survey shows that market participants believe reciprocal tariffs coming in April will amount to a 9% reciprocal tariff rate. Goldman itself expects that initial tariff rates could be double that, which would set the market up for a negative surprise next week. And this headline, didn't really hit the markets the way you think it would. It says here, U.S. could adopt a tool to apply up to 50% tariffs on partners, according to the Financial Times. And Trump considers a two-step tariff regime on April 2nd, which is basically the first round of reciprocals come on April 2nd, and then a more severe round come after that. So again, just a continuation of trade war drama, essentially. Now, also in the news today, India is open to cutting tariffs on more than half of U.S. imports. In response to the Trump administration's upcoming reciprocal tariff policy, the Indian government is reportedly willing to reduce tariffs on 55% of U.S. imports worth about $23 billion, down to as little as zero from a current range of 5 to 30%. The risk reward is favorable for the Indian government, as it estimates as much as $66 billion of its exports to the U.S. would be hit by tariffs under President Trump's new policy. Now, here on the day today, the CNN Fear and Greed Index is sitting at 28. That is a sharp move higher from some of the, well, it's at 30 now, it just moved up. That's a big move higher from some of the lows we were at over the past couple of weeks, being in extreme fear, like 18, 17 at one point. You've almost doubled the headline number on the CNN Fear and Greed Index. Market momentum, extreme fear. Stock price strength, extreme fear. Stock price breadth, extreme fear. Put and call options, extreme fear. Market volatility is neutral. Safe haven demand in extreme fear. And junk bond demand currently in greed. If you take a look at the percent of stocks trading above their 50-day moving average, today you're not doing a whole lot of anything, down about 0.5%. 33.34% of stocks are currently trading above their 50-day moving average. And we will get a new AI investor sentiment survey coming out this week. That should be coming out on Thursday. We really want to see, do the bulls rise following the little bit of a rally we've seen in the markets? Because you've been around 60% of investors bearish for over a month now. This will be the 5th week in a row if over 50% of people are still bearish. And you've been closer to that 60% level again the past 4 weeks, which is kind of unprecedented. So again, we did get some data out today. Richmond Fed Manufacturing Index came in at -4. Expectations were +8. Manufacturing shipments, -7. Expectations were +2. Services revenues came in at -4, expecting +3. So across the board, you had some pretty weak data today. S&P Case-Shiller home price year over year up 4.7% versus estimates of 4.8%. There was really nothing good about the data today, but this data is soft data. The soft data has already been really bad. But tomorrow we get durable goods orders. Now for January, you came in at +3.1%. Here's the deal. A lot of retailers were ordering things in anticipation of tariffs. Well, we've heard that consumer demand has been really weak throughout all of Q1. So your durable goods orders for February, in which we get out tomorrow, they're expected to be -1.2%, but you could see a really negative number here. Imagine, if you're Walmart and you ordered a lot in January and you're like, oh crap. Well, the tariffs didn't exactly come. People are not rushing into stores to buy things. They probably didn't order nearly as much in February. And you could see a really negative number there. That is hard data. That will be important to drive markets tomorrow. On Thursday, you have GDP growth rate, final numbers for Q4. That shouldn't move around too much. But again, it's always possible that it does. Initial jobless claims, continuing jobless claims, a little bit more of that hard data. Kansas Fed Composite and Manufacturing Index will also be coming out on Thursday. But Friday's the big day. Personal spending, personal income, and PCE. As we shared, we already kind of have a good understanding of what PCE is going to look like. Personal income is a secondary catalyst behind personal spending. And we talked about this in the previous video. But for January, personal spending came in at -0.2%. From all indications that we have, whether it's earnings or soft data, specifically earnings from retailers, they're all warning about the consumer. Okay, if those warnings are correct, you're probably going to see another negative number. Here's the deal: you haven't gotten 2 negative numbers back to back since the drop of the COVID crash. Okay, you've gotten 1 negative number here, March 2023, another one here was 0% November of 2022, 0% in July of 2022. But getting negative numbers is pretty rare. Like, it really doesn't happen. So January was a bit of kind of a wake-up call. But if Friday's personal spending number is also negative, there's going to be a lot more talk about a potential recession on the near-term horizon. So unfortunately, no matter what happens tomorrow, no matter what happens on Thursday, Friday is the day where markets are going to move big. And as I've said before, I do think markets could continue to move higher if the data tomorrow's okay, Thursday's okay. Friday's the big test. I think you're going to get probably a 2% swing on the SPY just on Friday alone. Now, you're about 2% off of your 50-day moving average. That's at about 588. If things are good, that's the level I'm targeting. Now, if things are bad, then you sink back into the low end of this correction range. And then probably subsequently following that, you hit new lows. As we've also talked about before, you've essentially reset your momentum indicators. The RSI is back to 50, so neutral. If you fall to new lows, you're not going to be oversold again. So you have more room to flush to a new low. Your 300-day moving average here, this white line, is the important level at this point. Last time you were here was 2022, and you did find some support here in October of 2023 when we did go through about this 10-11% correction or so back then. So that's a big level, but really, you could be vulnerable to coming down to this 500 level on the SPY, and I think that's where the risk reward becomes at parity, right? Potential 20% upside, 20% additional downside from that point. That's the area I feel more comfortable buying heavier in this market. I think that's where you can actually go out and buy the headline SPY with a little bit more confidence. But here at these levels, yeah, it's not an attractive setup for this year, especially given the continuing new information that we get on the economy that shows things are not getting better, they're getting worse. And nothing is a guarantee. Anything can happen, and you should be prepared for both sides of things. You should be prepared for a recession. You should be prepared for stocks to break out to new all-time highs. That's the difficult part about this market. You have to be prepared for both sides here, so you're able to capitalize if stocks do fall and you have cash on the sidelines, but you also don't miss all of the rally if, markets do go back to new all-time highs. That's the challenge right now. Let me know how you are threading that needle down below in the comment section. Have a fantastic rest of your day nonetheless, and I will see you in the next one.